Well, for the equity market, what's been on our mind, and this was sort of central to the equity component of our mid-year outlook that we just published, is this divergence that you're seeing in breadth. The fact that the average stock, when you look at the percentage of companies above their 200-day moving average, when you look at percentage of companies outperforming the S&P 500 on a rolling 3-month basis, that's remained pretty weak because you've gone through another kind of bout of AI hype, especially within the semiconductors. So that in and of itself is not a horrible omen for the market. We've seen it actually resolve itself. Those divergences resolve themselves in a positive way over the past couple of years when they have happened.
Yeah, and even in the past 3 days. I mean, when I got the Dow moving up and I see some of the mutual funds giving me better returns than Broadcom.
Yes, yeah.
There's something going on out there, isn't there?
Yeah, and I will say the new norm, the last time that you actually saw a lower percentage of that metric I mentioned, the percentage of companies that are outperforming the index on a rolling 3-month basis. The last time you saw a lower percentage, so sub 23%, was 23 and 24. Before that, you have to go back to 1973. So, of course, very different market backdrop. 73, the start of a horrible bear market. 23 and 24, more consistent with correction. So it is more of the norm these days, given the concentrated market.
Well, let's just say futures negative 50 right now.
Kevin, we're in a time here where very active equity new issuance in the marketplace. We had this monster mega deal from Google this week, from Alphabet. The market took it in seemingly very well. And then, of course, we've got all these IPOs that are tuned up. SpaceX on the road as we speak. Then maybe some of these AI plays come. Huge transactions. What does that tell you about this market here? How do you guys think about it?
So I think it does underscore, of course, that the sentiment environment is certainly getting frothier. Whether you think of it as frothy or not, I think that's always just kind of up for whatever the person's perspective is. I will say, I've been traveling the past 4 weeks almost nonstop all over the country, also in Korea. But in the U.S., when I've been speaking with our investors, there's actually been a sort of a elevated degree of skittishness or hesitation around just the environment of mega cap IPOs in general. So the attitudinal sentiment is not necessarily matching up with the behavioral sentiment that we've been seeing in terms of really stretched fund flows and how much has been going into tech and how well semis have been doing.
Yep.
So to me, that sort of lays the framework, I think, or the groundwork for maybe a little bit more room for sentiment to get stretched to the upside. Of course, I think the game will change a little bit after we do get a lot of these companies coming online into public markets. But I haven't yet felt, at least, that on the attitudinal side, there's been a lot of that hype that has matched what we've been seeing with people, what they've been doing with their actual dollars.
And I guess, if you want to take the bullish side here, which is probably the right way to be, earnings have been there. Earnings have supported this market, it seems like. And how do you think about that going forward?
I mean, I think, of course, the breadth of earnings is actually, if you just want to look at the number of industries that are seeing their earnings grow, yes, the breadth is there. Of course, the magnitude in terms of concentration, it is a little bit more skewed towards the large caps and the mega caps. I do take the optimistic side and angle of that, where if you look over the past several decades, the growth in that earnings share for that cohort has grown. So it's not like it's been totally unjustified. But on the flip side, you do have more reliance on a smaller share of companies. So to the extent that they can't keep up with expectations, to the extent there is a disappointing, quarter or series of quarters where CapEx estimates for some reason have to come down, or earnings estimates, get revised lower, of course you always run the risk. But that's why we make the case for diversification within the equity market, because you've been able to, that's been the best way to play this, especially with even a sector like healthcare over the past couple of weeks.
On the road, and with the new Schwab commitment to wealth advisors and all that, huge announcements from Schwab over the last 10 days on this. On the road, in the trenches. Paul and I, it's cushy. Paul gets in the Gulf Stream and he goes out to San Francisco and he takes the ferry home and sits there with a beverage of his choice. It's a can of Budweiser. And I'm in the Bentley going up Madison Avenue complaining about the traffic. You're in the real world.
Yeah.
How do you respond to people who raise their hand and say, I love all your optimism, we love Liz Ann Saunders, but we're scared stiff? How do you respond to them?
Well, frankly, we don't get a lot of clients who exhibit a lot of fear, especially if they're working with an advisor and taking an advised approach. I mean, I've always been a believer that is the benefit of working with somebody, taking your own personal emotion out of it. But seriously, I mean, that is actually the biggest split I see, especially when I talk to people, who are newer to markets, this kind of newer retail cohort that, just is still getting into this, still getting into investing and learning it, not necessarily working with somebody. That's where you see some skittishness around, what do I do with a big drop in the market? What do I do when I see a particular stock or industry go up by 20 or 30%, in a day? So I haven't been met with as much fear, but as to my point around some of these larger IPOs and just the sentiment environment, that was where there's been some, I guess, concern over whether this is, too hyped up. And I think it comes back to, my favorite quote ever about markets is from the late, great Sir John Templeton, bull markets being born out of pessimism, growing on skepticism, maturing on optimism, dying on euphoria. That is, I think, the perfect way to the perfect overlay that you can apply to really any cycle. It doesn't say anything about earnings, doesn't say anything about valuation.
When you're on the road seeing your clients, are they looking to embrace these markets here, or, like as Tom said, maybe a little bit skittish? Are they looking to maybe reposition? Maybe I should own some more bonds. Maybe I should own some gold. Maybe I should maybe a little bit more cash.
Yeah, I haven't seen the willingness to embrace markets fade materially. If anything, I think the bigger concern has been more on the economic side, and actually the dominant question I've been getting, and the first question I've been getting at every event, is the concerns over AI in the labor market. That has actually been, and from all age groups across the whole spectrum, from Gen Z, to people who have been investing for decades. That has been the dominant question that, of course, nobody knows the answer to. I tend to have a relatively optimistic view, in the end, the end game of this, not necessarily being tens of million jobs just fading, out of the economy, but that has definitively been the main question.